When you're young, you need to start investing as soon as you can, and you need to buy houses as soon as possible and that you can afford it, because time is on your side. And it's not rocket science. Yep. Einstein said it. He said the eighth wonder of the world is compound interest.
Yep.
So I remember one of my first meetings with a realtor. I remember taking her out to lunch. The last thing she said to me, Paige, no offense, but I have shoes older than you. Why would I give my $1 million clients to you? I know you're out of college. I know you're new. You don't have the experience, buddy. You look young. You haven't been in this business long enough. I like you, but you don't have the knowledge and experience yet where I'm going to hand this over to you. So that was a big wake-up call for me.
So we'd like to welcome Paige Sturgeon to the CashFlow Quest. I've become a really good friend of ours. We love to share stories about different deals and things, and so we really appreciate you joining. We want to really impart 3 main discussion points to our viewers, which most of them in our realm, they'll know you, sure. Or a handful will at least. And then we're looking to kind of explore these topics where they all kind of roads lead to cash flow and passive income. Mm-hmm. At the end, right? Like you can have a really active career, but you kind of get to the point where you're like, okay, I'm tired of the grind and I'd like to go more towards passive income or cash flow.
Correct.
So it's whether you know it or not, that's really the end goal.
When you're 20,
don't know that's really what they're after, right? Yeah.
When you're 20, it's not so serious because you got time. Uh-huh. And then as time goes forward, you're like, okay, I don't want to grind this out as much. So one is, what did you do? How'd you build it? Kind of the origin story. And then that can kind of have some fun with faith and, what caused you to kind of stay persistent in that. 2 is knowing what you know today. What would you teach somebody that's really important to you to replicate the same business? Because I think there's some fun in like knowing, this system and this tool. I went to this training or something. How would you do it today? How would you coach your son or somebody equivalent to that? Mm-hmm. And then 3, how do you view cash flow today? Is it more important to get started younger versus now? How would you kind of impart that wisdom?
Mm-hmm. And to add one more thing, Paige, you're a successful mortgage broker today as your career. And so,
real estate investor.
And real estate investor,
on
100%.
his own. Yeah.
Yeah. So, how did you get there? Mm-hmm. Let's start there.
Okay. Yeah. Thank you. Yeah. Well, I'll start back kind of in college. Okay. I went to Cal State Fullerton, and I thought I was going to be a lawyer because my uncle became a judge here in San Diego. And so when I was little, I used to walk downtown El Cajon where he'd practice as a lawyer with my grandma. We'd walk because we lived on Mollison back in the day, and we'd see him practice. And then back in the day, because I'm old, People's Court with Judge Wapner was really popular. So I was really interested at a young age in law and legal system and all that. So I applied, get accepted to Cal State Fullerton because it was still only 2 hours away as Orange County. I got accepted to state, but I wanted to get away and have a college experience away from San Diego. So I was a poli-sci major because I thought I was going to, get into law and maybe become a lawyer because I was interested. And then when I got into college, I realized that I didn't really like some of the poli-sci classes. I liked them. I did well. Maybe that's not what I wanted. Because after college, I was like another 3 years of my life for law school or 2 years. I was like, no. And so a crazy thing happened. I switched my major to business, because I thought that'd be more practical. Because I was interested in money at that time. When ever since I was little, I like Monopoly. So that comes into play later in my life.
Sure.
Because when you're little, you play Monopoly and you can play for hours because you want to own stuff and have people pay you and all that stuff, right? So
that's cool. You were into that.
So it was really cool. So at a young age with money, I was fascinated with it just because of Monopoly. I guess I wanted to be Donald Trump Jr. maybe at that time. I don't know. So what's crazy is when I went to college, you have to do your general education requirements. And I took German in high school. So fast forward to college and I'm looking at my 101 requirements, humanities, like, hey, language, German 101. So I ended up taking 3 years of German, by the way, in high school. And towards the end of the semester, my German teacher says, hey, your German's pretty good. And there's a study abroad program. Here's a brochure. You should probably apply. And one of the requirements is you need a letter from a faculty member, to recommend you. And I'd recommend you. So I called my dad, and I said, hey, I'm interested maybe studying abroad for a year in Germany. What do you think? He's like, well, if you get accepted, we'll figure it out. So I applied, blah, blah, blah. Long story short, I get accepted. So before I knew it, I was on a plane with 20 other Americans from all the Cal State systems. And it was 1989. I flew to Germany and I studied in Germany for a year. what was really cool in 1989 in Germany, as most people don't remember, is I was there when the wall came down.
Whoa.
So I went to class and my teacher says, hey, see you later. See you in a week. Go be a part of history. So me and my buddy, there's a thing in Germany where you sign up where you can hitch a ride as long as you help pay the gas. And I was in Berlin 2 days later. So I was on the wall, getting my own pieces, being a part of history. Because, communism, our generation was a real deal. And it was the Iron Curtain and it was the evil empire. It's kind of going that way now, like historically, but that was really cool. I was 20 years old.
We've been to that wall, actually, in Berlin.
Random,
the piece that's still there.
Right, Checkpoint Charlie, probably.
Checkpoint Charlie,
yes,
that's
of
it.
Course.
Yeah.
So we went there for Dad's blindness. There was one guy that in the world that would try an electronic stimulation on Dad's head and eyes and to stimulate his optic nerves. We had to stay there for like 3 weeks. So we ran around all over Berlin seeing what there was to see. And we heard the whole story. And to your point, we really didn't previously know how recent there was a crazy communist breakthrough there.
And we remember thinking 89. I was alive in 89. Right. So that wasn't long ago.
No, and so it was really cool, to be a part of that. And it really opened my eyes to the world and travel and culture and history and all those things. And then the second thing that happened when I was there is I was a football player. I hated soccer. Right. And I was like, oh, that's a wussy sport. But when I got to Germany, all my German friends, they were absolutely bonkers over what they say football, but we say football, soccer, right? Yeah. Football, right? And so I started, watching football. I started going to some matches. And then it was the World Cup in 1990. So I was there when Germany won it.
Wow.
So, and I was a part of that craziness because the whole town went absolutely bonkers. They didn't flip cars over and light them on fire, but they were throwing some bottles and having fun. Right. So those two things opened my eyes at 20 years old. Like that was pretty cool. 2 big events when I was in that country. Right. So I come back to Cal State Fullerton. Right. And I changed my major. I changed it to international business because I think, hey, maybe I'm going to do import export. Maybe I'll become a foreign service officer, maybe an ambassador, whatever. I was really international thinking because I traveled to many different countries when I studied there too. So I changed my major to international business. And then I also worked in the International Student Affairs Office. So what I did is I learned about all the study abroad programs and the work abroad programs because I had to teach people how to do it. And so part of that, I learned about working abroad. So at the time, I worked at Bank of America, as a teller and new accounts and stuff. So I had a banking background and I had a German background because I studied in Germany, right? So I applied for this work abroad program in Switzerland to work in a Swiss bank for the summer. And I got approved because they say, hey, you work in an American bank now. You studied in Germany for a year. So you have the banking background and you have the German skills. And so they accepted me. So before I knew it, in 1991, in the summer between my semester, before I became a junior, I went and worked in a Swiss bank for 3.5 months.
That'd be interesting.
Bern, in the capital. It was the 16th largest bank in Switzerland. It wasn't the big ones, but it was it was called Migros Bank, which is Migros, the bonds of Switzerland. So they had their own bank because they're a huge chain in Switzerland, right? If you go grocery shopping, you usually go to Migros. It's a small little convenience store, right? So I worked for that bank in their credit department. I was one in a department of 10 women. So I was one guy with 10 women, and my boss could not speak High German. She could only speak Swiss German. So her daughter would have to tell me in High German that I know. Because Swiss German is a totally different dialect and language.
I was actually wondering about that. Okay, I thought they spoke German.
Schweizerdeutsch, which is not Hochdeutsch, which is High German, which they all learn in school. So basically, she would tell her daughter, and then the daughter would tell me what to do. So I basically worked on computer system doing credits and debits of people's checking accounts. They would come in, and I would credit and debit deposits, almost kind of like a teller. But it was really cool for me because every weekend I traveled to somewhere in Switzerland, right?
Yeah.
And I ran with the Bulls in Spain during that time and did a bunch of crazy stuff because I was like 21, whatever.
Right.
Oh, wow.
So I come back and then I kind of like international business is generic. So I majored in the finance portion of it. So international finance is my degree, double major with German. Okay. And so when I was graduating, I applied. There was job fairs at Cal State Fullerton and there was not really a lot of international import-export, but there was a container company out of Long Beach that were selling container shipments to Asia. So I applied and gave them, my resume and they said, yeah. So I was going to make $40,000 a year salaried selling containers out of Long Beach to Asia. basically Japan, all that, right?
That's a big hub for containers, right?
It is. And there's commission and all that, but I'd be living in Long Beach and blah, blah, blah. And so when I went to a graduation party and my brother-in-law was there, okay? And my brother-in-law was in the mortgage business.
Oh.
And he says, hey, man, what are your plans? Like, after college, he's all, well, I'm opening a net mortgage branch in La Jolla. He's all, I could teach you the business. You have, you're a finance.
Right,
and
you'd get it.
Banking background. Because I worked for Bank of America for 4 years, right? So he's all, hey, if you want to move back to San Diego, I'll teach you the mortgage business. I said, yeah. So I was like, okay, Long Beach selling containers, which I don't really care about, or I can come and learn the mortgage business. So I was like, yeah, done. I'm coming back to San Diego. Working in La Jolla is not bad, right?
Yeah.
But his whole rule with me was like, hey, you're 100% commission. I'm not paying you anything.
So that was a big kind of a leap.
It was a big leap.
Yeah.
So I basically had 3 jobs, okay? Because I wasn't making any money. I had my student loans kicked in.
Yep.
Right?
So you were making payments.
That's right. I was making payments. I deferred as long as I could, right? But I was valeting cars at Sequan till 4 a.m.
Wow.
Wow.
I went to Sears because I was at the Union Bank building in UTC and Sears was right across the street. So I looked over there and I go, I need to pay my bills. So I went and applied. I was selling TVs and stereos in Sears Brand Central. My friends from college were making fun of me because I had my badge. Sears Brand Central.
Hey, Sears was a big store back then.
Hey,
that was a happening place.
Selling TVs and stereos. Got to get the warranty.
Yeah, of course. Upsell that.
Valeting cars and then do mortgages during the day.
So you could build a book.
That's right.
Yeah.
Because so I remember one of my first meetings with realtors because I had to go calling realtors. And it was open offices back then. So you can go and mingle, give flyers, go to their open houses, go to their brokers' opens, do that type of stuff. But basically, it's like you got to meet with them and try to get them to use you or give you a shot, right? And then here I am, 24 years old. I look like I was 18. You know what I mean? I remember taking this high level realtor out and then she had a couple listings, actually at the time, Rancho Santa Fe. Right. And I think the houses were $1 million or $2 million back then. That
was a lot of money back in the day. You'd love to get that loan.
This is 1995.
Okay.
What's a normal house? Couple $100,000?
Yeah. Back then, couple $100,000.
Yeah.
Okay? And so I remember taking her out to lunch and we hit it off. It was great. She liked me. And then the last thing she said to me, she's all, Paige, no offense, but I have shoes older than you. Why would I give my $1 million clients to you? I know you're out of college. I know you're new. You don't have the experience, buddy. You look young. You haven't been in this business long enough. I like you, but you don't have the knowledge and experience yet where I'm going to hand this over to you. So until you're more seasoned, blah, blah, blah. So that was a big wake up call for me. I was competing against guys a lot older than me, had a lot more experience. And so it was like, okay, that was a tough pill to swallow. You know what I mean? So, but I remember it was so boring my first couple months in the mortgage business because I was reading FHA manuals, underwriting manuals, VA manuals, Fannie Mae, Freddie Mac rules, all the rules because I had to know. And then I had a guy that he was a little bit arrogant that was teaching me. He'd throw a calculator at me and said, pre-qual me. So I'd ask him questions. He's all, why are you asking me that dumb question? So I had to learn pretty quickly, I was thrown into the fire because he knew I was family. And so I don't think he really respected me a lot because it was like, oh, he's just he's a family. The reason he's here is because of family. Right. And so
he was just he wasn't involved in your family.
No, but he was
related.
told he had to train me because he was successful and he didn't have time for me, really. He didn't care. And so he was, he was rude to me, basically.
You probably learned a lot, though.
I did. I did. I mean, if you didn't have thick skin, do you know how many times I questioned if I was doing the right thing? Because my friends that were in college were now working for pharmaceutical companies and big 6 accounting firms and making good money. And I'm grinding 3 jobs, right? I think my first year in the mortgage business, because 1994, when I didn't start, I think until the end of the year. So in 1995, I remember getting my W-2. I made $21,000, for mortgages, and then what I made at Sears, and then what I made valeting cars. Right?
So you got a couple deals through, or whatever.
Yeah. Well, again, the loan amounts were a lot less, so I did my fair share, but it wasn't. It's not enough to be sustainable. Sure. Right. Mm-hmm. Okay. To do one job, but I remember, dude, I had a pager, bro. This is before, you know, and then I had a block phone. It was like a brick, dude, my AirTouch phone. Okay. I remember because I lived in PB. It was Saturday. I'm on my beach cruiser going to meet my friends at the open bar.
With your block phone.
With my block phone. No, actually, it's before my block phone.
Okay, you got Paige.
I got changed. You know, I was like, my laundry money. And I go to a payphone calling realtors on Saturday in PB. I mean, that was my life at that, right? Whatever. Hey, someone's calling me. I got to do something.
Hurry, get to a payphone. Yeah.
I was like a lab following, a tennis ball.
Okay, wait. I need a refresher. So let's say somebody was reaching out to you. Yes. Would they take their pager and send you a page? Like,
you'd call the pager.
You'd call and it'd beep you
and then
or buzz you.
Push a button on the phone, right? To like page them. And then you'd call the pager. It was a phone number.
And then they would wait for you at the other end of the phone.
Yeah, to call.
Which is kind of wild, right? Because then you got to find a payphone in a hurry.
That's right.
Yeah. It could be.
And PB, I knew where they were because it was Saturday or Sunday. Because that's when realtors are showing houses and they got a buyer come in on an open house, and they're like, "Hey, I need them pre-qualified. Can you jump on it?" Yeah, I'm available. Let's do it.
I'm on my beach cruiser at the bank. I can do it right now.
But I remember this is part of
this
is part of the journey. And the other thing I didn't talk about too is when I was getting in the mortgage business in 1994, it was a recession then. The economy, because going back to the Cold War, okay, there was a lot of government contracts there, General Dynamics, and a lot of government contracts with defense. So when the Cold War was over, they weren't spending all these money, right? And so it created a recession, especially in San Diego, because there's a lot of military private contractors there.
Yeah,
got it.
Right.
I remember Stay Alive till 95.
So guess what was going on? There was foreclosures then. There was REO properties then. There was HUD repos or FHA loans that got foreclosed on.
Okay.
And so I started doing these loans that were called 203Ks, FHA 203K loans, because no one knew them about. They were triple the work. They were basically like you'd buy the house that was in need of a lot of repair, and they'd give you extra money to rehab it and buy it. But you had to get a contractor that was, that FHA HUD would approve it. Then they had to get inspections. There'd be a draw schedule and way more work, way more intensive.
And it'd be like 100% or like 120% loan to value.
That's right. They go off the future appraised value after it was done.
Yeah.
So you could borrow more money to rehab. You'd get contractors' estimates. You'd have to get their resume,
Who ran that product?
Certain banks did.
Okay.
But you had to learn it. And a lot of people were intimidated by it and all that. And so I was like, I had free time. I wasn't doing a lot of deals. So I started doing them. And I started going to realtors' offices. I started educating realtors on it. Like, hey, you can sell this REO with this product and not have to worry about, it being a cash only sale or certain things.
Yeah.
And so I started doing those loans. I think it was like up to 125% or something like that, right? If I remember right. And I started doing them. And that's how I got into the realtor world, because I was doing things that other people weren't willing to do, because I would do double the work just to get a relationship, right?
Well, and that's a win-win, because now you're helping them get a sale and you're getting a loan for yourself. And so they're that's an incentive to work together.
You were sort of ahead of the rest of the mortgage business to get into the way of growth, which was these kind of weird houses that need a lot of work.
Yep.
Right.
People were going to be more active in that. I get you.
Yep. Yeah. And so that kind of got me, some
street
new
cred
relationships. Yeah, because then I was doing these tougher loans that other people weren't willing to do. And then I started getting, your vanilla deals and your other deals, and they could see, and I was aggressive. I was quick to respond, and people liked me because I was professional and I had integrity and just basic things you would think that's not rocket science, right? Because I always looked at relationships as when the transaction closes, that's when the relationship begins for me.
Right.
Because it's like, hey, I'm your consultant now,
Yep.
So you're going to have all these questions about your supplemental tax bills or things you're going to get in the mail you don't know because you're a first-time home buyer. You're going to call me because I'm going to be use me as a resource or your lifeline, because I want to be your mortgage planner. See, changing the philosophy, because those on their business cards say loan officer, mortgage broker. No, I say mortgage planner, because I'm planning for their financial future, because real estate could be a bucket for financial independence or passive income. So that's my take on it. Like, hey, this is your first house. And I've had people that bought like a 1-bedroom, 1-bath condo, and now they own multiple properties, because you don't know who's going to be successful. Who's what? I treat everybody the same. Doesn't matter if it's $100,000 loan or $2 million. I know that sounds cliche, but it's true. Give them the same service, the same amount, because it's not about the money. It's about the relationship. And if it's like biblical, man, because I'm Christian, right? It's like love thy neighbors yourself. Okay. It's like if I am taking care of their needs and putting their needs before mine, God blesses is going to honor. I don't worry about it. If I'm helping people be successful and achieve goals of home ownership or financial independence or getting out of debt, learning how to budget, I have to teach people how to budget. I give people credit 101 classes. I give people financial 101 classes because they don't know. They're not taught this.
No, it's not taught in the schools. And so if your parents don't teach you or you don't actively, go look for it, then they need guys like you to give them, budgeting 101. That's the truth. So that's amazing. Yeah.
What's really cool too is like when you have clients and you see their success, ask questions.
Yeah.
And I'm reading their stuff. Like I'm reading their tax returns. I'm reading their credit reports. I'm reading their asset statements.
You see how it
I'm
comes
reading
in.
their profit and losses and their balance sheets. So I had to learn. That's what I love about my job. I'm always learning like new things, like even this bucket that you guys do of the mobile home manufactured home bucket and the depreciation, the tax benefits. I'm diversifying my portfolio because I need to.
Yeah.
And I wanted to. And because I own multiple properties and I got sick and tired of being a landlord for a certain part of it, the condo part of it, because the HOA piece keeps just getting more expensive and violations, and usually the HOAs aren't run very well. And it would just, as I get older, I'm 55 now, it's like, I want my life to be a little bit more kind of smoother and running where I'm not having to manage everything so much. And I still own properties. It's still a bucket I do. But I ended up last year selling 3 condos with a partner. And then my partner told me about you guys and what you do. And I was really interested and intrigued. So I met with Ben and you and went to lunch, see what you did, see what the model is, learned about the tax benefits of the depreciation because the tax is very favorable in this piece. And I usually do 1031 exchanges because that's what I do. I don't want to pay taxes.
Right.
I work hard for my money. And so there's no reason to give 30% to the government, to the state and the feds. I work too hard for it. So I was like, okay, well, if I'm going to do this, I couldn't really 1031 it because it's too complicated. But I could, with the depreciation, basically offset most of those gains. And then, hey, I do own an asset class that I didn't have before. I'm diversifying. I get my return of, 5%, right? And then there's a longer term play of, hey, if you sell it, I'll get my piece. Or maybe if you refi, I get my money back. We go into another park, whatever. So for me, it made sense. And I know right now, you get 5% somewhere else, but right. And high yield savings or whatever, right. Or T-bills, right. I do that too, right. It's another piece, another bucket. Sure. Okay.
But right now, everyone's hedging, thinking treasuries are going to go down.
That's right, because rates are going to come down. I'm going to get busy again. I'm going to need something to do with my money. So
and then our 5,
I have to give you some more.
Our 5, which we just start at, by the way, but our 5 will look better and better again.
And you get the appreciation that is attached to that.
The whole thing.
That's the bottom line.
The depreciation.
It's not the coupon.
And the property appreciation, where sometimes in the bonds, you're not getting that piece, right?
That's right.
Tax savings, initial principal
and
growth.
And the appreciation growth.
Absolutely. Yeah. Those are 2 huge pieces I didn't say, but those are absolutely, that was for me, the icing on the cake, no brainer for me to do it.
Sure.
Okay.
Yeah. Yep.
And I have a friend that owns a manufactured home company here in San Diego. Right. And so he's invested in this space. He's told me a lot of good things about it too. He invests with another company in the Midwest, which I reached out to. Wasn't very impressed with the service and wasn't impressed I wasn't really a big hitter. Right. And so once I found out about you guys, that you're East County family. Okay. And then we were actually neighbors back in the day and we didn't even know it at the time.
That's so ironic.
It's so crazy. They lived across the street from me, their parents, and they were in high school when I was in the mortgage business and, I didn't really connect with them, but it was that connection of East County family. A lot of my friends were invested in it. And I'm loyal guy. Like I believe in small businesses. I believe in family and helping each other grow and be successful. And so that piece was way more than some, Midwestern company that is in this space as well that I didn't know, probably wouldn't meet. Maybe I'd fly back out there and see what they did. But you were so professional, polite. You've been doing it a long time. Your track record speaks for itself. I loved Ben and his background at BlackRock. So for me, it was like, because at that time I was thinking, hey, I'm going to sell these. What am I going to do? Am I going to go buy units again, in this crazy market, and I'm going to probably overpay and have to manage all these? And then it made sense where I don't have to be labor intensive. I trust your model. You guys are the experts. You take my money, invest it, do well. and you got the track record for it. So
thank you.
Yeah, we really
those
appreciate
are nice
that.
Compliments.
Yeah. Seriously.
So
thanks for the kind words.
But yeah, along my journey, so going all the way back to mortgages again.
So if you were going to teach your son or somebody just kind of getting off the ground into a mortgage planner kind of position, how would you tell them, if they said, do you have any recommendations, or, what would you do different if you were going to do it all over again? What would you tell somebody like that?
Okay. That's a really good question.
I feel like it's a pretty dynamic market right now too for that lesson to be had.
Hey, the lesson to be had really, it all boils down to this one simple fact. Okay. When you're young, you need to start investing as soon as you can, and you need to buy houses as soon as possible and that you can afford it, because time is on your side. And it's not rocket science.
Yep.
Einstein said it.
Yep.
He said the eighth wonder of the world is compound interest.
Yep.
He who understands it earns it. He who doesn't pays it. And a lot of people pay it because they don't understand it. So teaching people at a young age the value of a dollar, how to budget, don't live off credit card debt because we're in a consumerism culture. Okay.
Totally.
And they're not taught fiscal responsibility by any means. It's up to the parents. I put a lot of responsibility on myself, especially if I'm investing in their future if it's a private school or college. It's like, I'm going to teach them life lessons along the way. Right. And it's in Warren Buffett. Warren Buffett and Charlie Munger. Okay. I read their stuff because it makes sense. And now obviously if you look at his pedigree and his, performance, and all that Berkshire Hathaway, they're even in this space.
We're big time consumers of their products.
Yeah.
We use their loan programs for the manufactured housing. We use their homes that they build. That they bought Clayton
homes,
and I'm sure there's something. But then now they have an insurance company for the homes. It's all integrated in Berkshire. Yeah, and then we use their brokerage. So we're buying the current deal from Berkadia.
Okay.
So they're going to get a fee there. There's like a partnership thing there with Berkshire. And then our mortgage broker is Berkadia.
Wow.
So, it's pretty crazy.
I'm learning stuff too. And it just because through the years, that's one thing too, is you need to read. Yeah. Okay. One thing that I did when I was traveling to real estate offices in a car, because I had to go all over the county and go to their offices, right? I had time. I turned my car into a classroom. Okay. So what I was listening to was Brian Tracy, Psychology of Selling. I was listening to Jim Rohn, motivational.
Love Jim Rohn.
Speaker. I was listening to Anthony Robbins, but I was listening to audio tape. Because I couldn't afford it. You know what I did?
Did you rent them?
I did. I went to the library. I went to the library and rented them.
Yeah.
That's what I did.
Well, and once you read them, once you go through them or listen to them, you kind of don't need it.
You don't.
Right.
It kind of just goes on a shelf.
So the library, that works great. Yeah.
And then what I did, because I got so excited about investing and money, because I didn't know. I wasn't taught this.
It's a whole new world.
Oh, it is.
So I read books. I read The Richest Man in Babylon, right? Yep. I read Think and Grow Rich by Napoleon Hill. He did a study on the most successful, millionaires throughout history and mostly US, right? And what made them successful and those personality traits and those characteristics and all those things. So it got me thinking about this passive income and investing. And so read the stuff that you're not taught in school, read about Warren Buffett, his story. Like I just bought a book today. I made my wife, she's like, gosh, because she orders everything on Amazon and I don't even have the Prime account. She does. I said, you need to order Poor Charlie's Almanac, which is basically Charlie Munger's almanac on his success stories and principles. I'm excited because there's going to be wisdom in there. And he passed away, I think last year, 99 years old.
Charlie Munger.
I do too.
We had a gal on, friend of Ben's from BlackRock, and they both worked there together. Now they've spun off, but she had lunch with Charlie like 3 weeks before he passed.
Yeah.
And he said he was amazing.
Yeah.
Just spent a little bit of time with him was amazing. So yeah, we're big fans of both of them.
So what I would do if I was young, when you can, if it's $50 a month, whatever, put it into an index fund, okay? Or a dividend fund or a mutual fund. I like indexes because the fees are lower. And it's a broader, because it for me, trying to pick a stock, it's like going to the horse races. It's too hard.
It's so hard.
It's too hard.
It starts to eat at your brain on
it does. And I don't have time.
Sell it.
And it's an emotional, like NVIDIA. There's a ton of people I know that got into NVIDIA early, right? And there's a ton of people that got into Zoom and these other ones late, right? And then they're paying the price now, and then it's up and down. So what I do is I do Vanguard because they're a discount brokerage, and I do index funds. And because that's what I've learned to do, because I tried to pick stocks. I've been through the dot-com bubble. I lost 40% of my money in 2000 because I was doing like my own stuff. But then I had a friend, because he was young and I wanted to help him. And he was very aggressive. Like he got in and he's like, yeah, you need to move around. And I listened. That was my own fault. It's not really him.
Yeah.
And I listened and 40% of my portfolio went away because it was in high risky stuff, just like it would happen in this boom, right? With, new energy and EV and, AI.
The AI
thing.
The
tech boom.
This year, AI went crazy.
It did.
Whatever that
whatever
was.
the space is, right?
But you were young and that risk was okay.
I learned my lesson.
You were like, all right, I'm going to do it and give it a shot.
Exactly.
Sure. Yeah.
And I stayed away from crypto because I had people taking money out doing cash out refis, throwing it into crypto.
Wow.
And as I think Charlie Munger said, he's all, why would I invest in rat poison? If criminals are, exchanging currency through crypto, why would I do that? So, and I stayed away from it.
I always appreciated his blunt answer on
I agree.
He's very direct and blunt, but I appreciate it as well. So I stayed away from it, right? But anyways, if you're young, start young. Index fund, a mutual fund, whatever, and dollar cost average, and just let the compound of interest of money just double.
Do its thing.
While you read your books and, audiobooks,
and do those things. And then when you get a job, I religiously, faithfully, 15% of whatever I made, I put into a 401k. Okay. And then what I did, because I'm the owner of my own corporation, I'm an employee, I match myself. Okay. And then I made my wife an employee and she does some clerical stuff. Now I also max her out and then I match her. So from double both of the side, I'm doing it legal. She's an employee of the corporation. And then now that I'm old, here's another thing. It's called the catch-up contribution. At 50, you can do this year in 2024, and I think another $7,500. Okay. So in 2024, you could put 401k, 23,000 max. And then if you're old like me, 50 or above, you can do 7,500. I think it's 7,500 or 7,000. So that's 30 grand. And then I can match myself. So I'm trying to maximize, and I've been doing that religiously. So I'm not bragging, but because I've been doing this since I've been 24, I have a couple $1 million just because I started at 24.
Right.
That's pretty amazing because most people don't start at 24.
Right.
20 to 40 to 50 grand a year.
That's right.
And there now grew to $2 million plus, or maybe a little more.
And I'm just letting it continue to grow.
And so are those funds then invested into the Vanguard indexes?
They're not. So that's a good question. I do that separately on my own. Okay. But we did paychecks, okay, because we're a small company, and what were killing us was healthcare costs. Yeah. Okay. And so what we did is now we pool, it's called a PEO, professional employee organization, where they pool your money, too. Right? Mm-hmm. So I had paychecks because we did the bundle. So they gave us, because we did everything together, healthcare, we did 401k, and we did payroll. Yeah. So at the time when we were shopping all that, it made sense. Yeah. Okay, to do that. So we did that. So they have a whole menu from anywhere from large cap, mid cap, small cap, international and all that, bonds, right? Yeah. So what I did, I've done mostly aggressive. I do very little in bonds. I've done like 10% in bonds, but I mostly do, I mixed it. I did large cap, mid cap, small cap, and international, those buckets, and kind of divvied them up. You know what I mean? Because I can't guess. I mean, right now, small cap's hot. So I'm crushing in that bucket, and large cap, maybe not as much. But yeah. So I just kind of diversify and then what I do every year, because I have my Wells Fargo advisor that does my stuff, I send him my 401k. I said, hey, do I need to reposition this? Every year I let him review it because I'm not the expert. I trust and rely on him. He's done really well by me. We've won many more times than we've lost. So I go every year, I send it to him. I go, hey, here's my asset statement with paychecks for my 401k. Do I need to reposition anything? What do you think? And every now and then he'll go, yeah, let's take some here and push here. Here's why. And I trust him. So, and I've done well by him. And so I keep doing it. My brother-in-law, I was a mortgage banker. Okay. So there's really 3 channels when it comes to mortgages. You have your retail, which that means you walk into a Wells Fargo, Citibank, Chase, San Diego County Credit Union, Mission Fed, whatever. That's your retail, right? And then you have your mortgage bank, which he was a mortgage bank. That means he was a net branch of a bank that was lending their own money. Okay. And then you're a mortgage broker, which you're wholesale, like Costco, which you're using other people's money, other banks you get approved with. Okay. And so I kind of work 3 channels. I work retail, but not mortgages. I worked for a big retail bank and I didn't really like it. very corporate, very structured, a lot of meetings, a lot of cross-selling, a lot of, if you don't do this, and I had to wear the 3-piece, the suit, and it was and then we did, during that time when I was at B of A, there was a lot of mergers and acquisitions. So I had to deal with that too. And where they tried to get us to part-time, then you have to pay full benefits. And anyways, there was a cool thing though about the tuition assistance program B of A did. They helped pay for my tuition because I was a business major. So I was good. Okay, so I took advantage of that to help pay tuition. But I didn't like the corporate, because after college, I could have went into the Bank of America mortgage program, right? And probably got hired and all that, right? But I decided not to. So that's retail. I worked for the mortgage bank in La Jolla. And then my friend, Jeff Merritt, who's my current business partner now, was a broker. And we would compete against each other out in the field. We were calling on the same realtors, going to the same open houses, especially East County. He's the East County guy. I'm East County guy. Calling on the same realtors, competing against each other. Then one day I went out to lunch. He's like, dude, let's go to lunch. So we're talking turkey. He's like, dude, I want to let you know, I'll smoke you on price. I go, no, you won't. Because I was trained, like, as a mortgage bank, we have control because our underwriters are in-house and that we're lending the money. And so we're better. And then we have more control, and that mortgage brokers are used car salesmen. They're sleazy, blah, blah. That's what I was trained. So that's what I believed.
Right.
And so I told Jeff this. He's all, bro, no, it's not. He's all, first of all, I have 15 different banks I could take your loan to. Okay, so I can beat you on price because they're competing against each other every day. I'll beat you on price, number one. So number two, your next 2 deals that your underwriter that won't approve, give to me. I bet you I can get them done. I said, okay, touche. I'll do that. At that time, my brother-in-law sold. And so at that time, I was starting to do well because my knowledge, my relationships were starting to pop and all that. And then, of course, there was a couple loans that were really difficult to get done. My underwriter said no. So I gave him Jeff. He closed them. He said, I told you, you're losing income, man. So you should really seriously think about coming to work for me, because he was open. You
guys similar age? Just curious.
I met Jeff in 1984 in high school. We played on the tennis team together.
No kidding.
Oh, wow.
Why my company's Granite Mortgage is because our common thread is Granite Hills High School. So Granite Mortgage is in Fletcher Hills, which is on the border of Elko and La Mesa, is because we went to Granite Hills together. Jeff and I opened Granite Mortgage in 2000. And right when we opened our doors, it was the Wild Wild West. From 2000 to 2008, we crushed it. And it was good and bad. I mean, because, for a while there it was good because, it was traditional. Check the tax returns, all that stuff.
So
right?
you ran through the wild.
I went through the Wild West, 100% financing, interest only, prepayment penalty, liar's loans, stated income baloney, right?
Wow.
Because it was very complicated instruments that Wall Street allowed and government allowed, right?
Yeah.
And
if you watched The Big Short?
Of course. Yeah. Read the book. I read the book before, Michael Lewis, right? But it's true when you read about it, it's kind of crazy.
Did a lot of your loans that you had done,
yes.
pop at the end?
Yeah.
Okay.
I would say, a good portion, but there's a lot of good loans too that we did, obviously. But during that time, it was out of control because they were doing option arms, stated income, and the payments would, the mantra was you just refinance out of the bad paper, because the market's always going to go up and all that stuff, right? We obviously
that's what was sold.
That was sold, right? And then in 2008, the whole house of cards came down, right? And then it was, short sales and foreclosures. And it was really crazy because I remember Jeff and I and Greg Phillipson, who's a real estate agent, very successful in East County, if not, one of the best, okay, who's friends of ours. And we were all sitting in our office. Our wives didn't work. And we're like, hey, Jeff, how many deals do you have? Hey, how many? We had 1, 2 deals. I was like, this isn't sustainable. So we came up with a plan to start flipping houses. We took seconds on our houses. We went and tried to get loans from banks. And we were pariah at the time as a mortgage company. They want to lend to us, right? But we got little, credit lines at the time, and we cobblestoned it together, started flipping, man. Our first house, we went to Harvard, got our PhD. We lost $100,000 on our first house because we didn't know what we didn't know. But to be honest with you, it was the best, learning lesson because everything that could go wrong did go wrong on that house.
Oh, yeah.
I mean, we had to get the sheriffs involved to kick them out, declared bankruptcy, had to go to court. The outside of the house he had money for. We never got on the inside. The inside was not done. We thought it was. And so all the money we had to put in it, and then the carrying costs, the lawyers to evict, all the stuff to go through. That was on our first deal, and we lost $100,000. So we're like, oh my gosh. But we learned because again, everything that could go wrong did go wrong, and we were able to sustain it and then get some momentum and start figuring out the game. I think we ended up flipping about 300 homes in San Diego.
Wow.
Okay.
That's a substantial
Over
number.
what period of time?
From 2008 to 2016.
Okay. Wow. That's a lot of homes.
It is a lot of homes, you know,
Yeah.
and if it would have been wiser knowing what we know now is to hold on to a few, right?
Did you sell all of them?
They had a double. Yeah, we did because at the time we had investors, right, that we had to pay a piece of, and we had loans on them, right? So we had to pay those loans off.
So you would have, if going back then, hindsight, you would have figured out a way to
maybe keep a certain portion of the portfolio. Maybe not even if we kept 5, you know, because they tripled, you know what I mean? Quadrupled, you know what I mean? And we could have gave them to each partner, like a couple, you know, and then we'd be in a better spot. But also, you know, at the time we needed an income.
I get it.
So at the time, it's like I had to put food on the table, pay my mortgage. You know what I mean? So yeah, in hindsight, if I had known what I know now, we'd have kept them. But at the same time, we needed income.
Sure.
So to pay our bills monthly. So
and you had kids and a wife.
I had kids and a wife that I wanted to raise my kids because that was important to me.
Yeah.
That mom was there to raise the kids, right? And be there to be the domestic engineer to make sure everything around the house was taken care of, right?
So you needed the money from that, but then you were still pushing the money into your 401ks.
I was. I never stopped. I never stopped.
You were still investing.
I was still investing every month. And I still invested, you know, sometimes it was like when I was really doing well, I'd do $1,000 a month into, you know, my own investments, dollar cost averaging and index funds, right? And then I, you know, did all the way down to $50 a month because I knew the good time value of money compounding. I still had to do something, even though, and you can always still do that. I still do it today. Like I'm not crushing it right now. During COVID, I was crushing it. So I was doing $2,000 a month, right? Yeah. But now I'm doing $200 a month because my loans, I'm not doing as much with rates going 11 rate hikes. Yeah. I definitely am not doing as much now, but I'm okay. It doesn't make me like comfortable to dip into some of my savings, but it's okay. You know, other people would love to have my problem, first world problems, right?
Yeah.
Because you have this picture in your mind where you want to be at 60. Because I had this goal of 60, like all my properties free and clear. I have 7 rental properties, right? So I have 2 that are free and clear now. So my goal is that, you know, to have the other 5 I have free and clear at 60. So there's my passive income. There's my monopoly piece.
Yeah.
Right. And then I play bank. I'm the banker. Right.
Well,
where did you pick those up along the way?
Yeah.
Just a onesie twosies, you know.
Unrelated to the flips?
Unrelated to the flips.
Okay.
Like a realtor would call me and say, "Hey, I got a good deal on this one. Do you want to look at it?" Yeah. Greg was a couple of them. Another realtor, a couple on my own that I exchanged. So okay, another one I exchanged. So downtown, when downtown was going crazy in 2004, I put a deposit down. Kettner trio at Kettner.
One of the new build.
The new build is a 1-bedroom, 1-bath. 800 square feet, maybe. Took a year to build it. I think it was like $399,000. Right when it closed escrow, I sold it for $499,000. So I made $100,000 doing nothing. Okay. And I didn't want to pay taxes. And I knew downtown was going to be overbuilt and it was going to be crazy. So I was like, this is crazy. There's too many listings. They're just building like gangbusters. So I was like, so I actually bought a house by San Diego State because I was like, oh, cool. So I bought a house on 54th Street, San Diego State, 1031'd it. You know, and then I ended up buying it for like, I don't know, $500,000 or whatever. And I ended up selling it like a couple years ago, just because there's a lot of deferred maintenance. And it was a great rental, but I ended up buying a brand new condo in Point Loma for $1.1 million, where now my cash flow is like I doubled it. Okay, even I have a small loan on it, but I exchanged it. So I moved from a 1-bedroom, 1-bath in downtown, bought a house by San Diego State, rolled it into this. It looks like a New York style loft in Point Loma, kind of near the Rock Church, Liberty Station. It's on the way.
Yeah, that is a good spot.
Yeah, and it's got a 3-tier, and the top is a deck overlooking the yacht club, barbecue seating area. Nice. It's really cool. So and you originally, how much did you put into the downtown condo? The down 20% at the time. So maybe like $50,000.
Okay. So you're $50,000, you got all your money back. You made $100,000. Then you exchanged into a house.
Yeah.
How much money did you make on that sale?
Oh, I think I doubled my money. I think $450,000.
Okay. So you're still $50,000 out.
Yep.
And
so
you're
10x,
like,
10x
at the second deal.
Yes.
Yeah.
And so now you've 1031 exchanged again into this Point Loma with this awesome deck overlooking the yacht club.
And it was always a rental, or did you live in it for a while?
No, it was like 1031, right? So I had to do it, the rental from day one. Plus it's brand new. It was only a year old when I bought it. It was one of the last ones the developer had as a model. And so I was able to negotiate at the time. And at the time it was so gangbuster. I was trying to buy in North County because I bought in Solana Beach 5 years ago. And I was trying to get like a beach condo so my wife and I could sell the house as we got older and the kids left. Maybe just live in a condo because we didn't need as much. So we're trying to buy a beach condo that we can Airbnb or whatever, make good money. I kept getting beat out because I was at 1031 exchange. They're like, we don't want to wait for you. People are buying cash, 100, 200 grand over. So I kept getting beat. After getting beat 10 times, my wife says, hey, there's this condo, brand new condo down in Point Loma. And it looks awesome. You should, check it out. I called the realtor and he's all, yeah, we don't have an offer. Make me an offer. I said, it's a 1031. He's all, that's okay. I go, I'm a mortgage broker. I know what I'm doing. I'm doing my own financing. I'll show you all my financials. I'm good to go. This is solid. I can close them 21 days or whatever, but it's an exchange.
Yeah. Okay.
And it's in escrow. So when it's halfway done, appraisal's done. So yeah, it's pretty solid, but I'm getting beat out by, he's all, that's okay. We'll look at it. So yeah, he looked at it, sent it to the builder developer and they took it. So I got lucky. I exchanged it twice, right? So I up leg every time, right? So I'm on my third up leg on it. I get a cash flow of about $2,600 a month on it. So, which is great. And it's brand new construction. So I don't have to work because the one by San Diego State, it's older. It was built in, I think it was in the 60s, 70s. And so the plumbing was going bad. I needed to get a new roof. I had to do this and that, right? And so it was just, again, as I get older, I don't want to be, doing property management as intensive. Yeah. I can do it. Yeah. I know I have the relationships. I can do it. I definitely do it well. But
sure.
As you get older, you want to simplify. So, but yeah, if you can do those models too, starting out, buying your first one and then, doing an 1031 exchange and moving it up, right? You can get into mobile home parks if you want.
Yeah.
Whatever you want to do, buy commercial properties or buy multifamily. Yeah. I know friends and clients that have done it and done very well. And I've learned from their success.
Sure.
Because I ask questions. And success leaves clues.
Yeah.
Continue to read and continue to learn. I'm still learning.
So knowing what you know today, what would be, if you don't mind sharing, kind of your perfect asset allocation or diversified portfolio of investments? How much in real estate? How much in stocks? How much in something else? How would you answer that?
Yeah, it's hard. I mean,
I know.
But first of all, obviously do what you can control first, and that is your retirement. So whatever you can do, if it's a 401k plan, simple IRA, whatever, get that going right away. Number one, because you're going to want that to compound throughout your life.
Right. And the sooner you do it, the more compound interest you earn.
Will tell you this. Anyone. I think if you started doing $100 or I can't remember the statistic at 25 as opposed to 30, it'd take double your time to be a millionaire just for those 5 years. Yeah. So start early in retirement. And if not, a Roth IRA. You can do Roth IRAs as well. Start with a Roth. Do that number one. Okay. And then, richest man in Babylon, pay yourself first. Okay. But if you're a Christian, also tithe, I think is very important. Okay.
Yep.
But richest man, pay yourself first as well. So I do that as well with Vanguard funds. I do it in index funds. So do that. Okay. Obviously, first own your own primary residence. Okay. Because paying rent. Okay. Let's get to rent. Okay. So if you're paying rent in San Diego, it's going to be a minimum, probably $2,000. If you want a house, it's going to be $3,000 to $5,000, maybe more. So let's say you're paying, a family, and you're paying $4,000 a month, right? So that's going to be almost $50,000 a year, $48,000 a year that's doing nothing for you. Okay. So as soon as you can buy a home, that's why I try to teach my people, even though it's a little bit of a stretch to get in first because you got a budget. Okay. You get to build equity a lot faster, the appreciation you're getting in early. You get the tax write-off. Or the government has taken a lot of things away. They haven't taken away the mortgage interest deduction yet. So take that to your advantage. And most of your loan is interest only in the beginning. So you're going to have a nice write-off. So own a home, get your primary residence, start early. Then from there, start to save so you can get a rental property. Okay. Or if you need to move up because your family's bigger or you need to be closer to work, you can afford it. Try to keep your primary residence as a rental.
Yep.
And then catapult now and buy another one. right? And so try to do that as much as you can, but you got to be disciplined.
Yeah.
You got to plan. It just doesn't happen. That's the problem, is people fail to plan. They're not thinking about these things because they're busy living life, raising kids. You know, the stress at work, trying to feed a family now. I mean, we're the latchkey generation. I'm a Generation Xer, man. 80s and 90s, best time ever, right? But it's the latchkey kids. Both parents had to work. That was the start of that generation, right?
And so, you might have months where, like, you know, especially when you're raising a family, something happens, life happens, something, you know, one of your kids gets hurt, so you got a big medical bill or something.
That's right.
And you can't even throw $50 into the account. That's okay. It doesn't mean that you can't next month or the month after. Don't let it derail you from your kind of your target and your goal.
So it'd just be interesting to see what your read on the crystal ball is with banking and kind of where you see loan products. If you want to take a stab at an interest rate prediction just because you're a mortgage guy, it'd just be fun. So any of that.
Yeah. So right now, I mean, the Fed has basically said that, hey, you know, looks like they're going to maybe lower here in September. They haven't outright said it, but it's like 75-80% chance that they are based on what they're saying.
Do you think that?
You know? Yeah, for sure.
Okay.
I think it'll be at least a quarter. Some people are saying a half. My prediction, not a half, I think a quarter personally, but it's already built in now. Like the market, the 10-year treasury, it's already down for at least a quarter cut. So people right now, I'm starting to refi and do some other stuff, but I still have people waiting on the sidelines because they're trying to time it because they think, oh, they're going to lower September. They might lower, keep lowering. True. But a lot of people, you can't always turn the market, right? And those people need help now. So I tell people, hey, it's good now. Maybe you should take it now.
Bird in hand.
Predict it. Yeah, exactly. And the rates just came down because they're expecting to lower. So if they come out and lower a quarter, which you're supposed to do, the market might not change. But if they say, hey, we're not going to maybe do further cuts or it's going to be delayed, then it could get worse. So it's not really the Fed meeting coming up. I think it's a foregone conclusion that they're not going to definitely raise anymore because inflation's starting to come down where they want it. It's like around 2.5%, I think. Their perfect top button is 2%. Unemployment's 4%, and I think now it's above 4%. It's like 4.3%. So now instead of looking at inflation, it's all inflation. Now it's like unemployment. Okay. So now that's their hot, because if you do things too much, then it's like a balancing scale, right? Teeter-totter, right? And so they're seeing that. So I think it's time for cuts.
The delayed effect of what they did a couple years ago.
Yeah, because you're always in the rearview mirror, right? It's like steering the Titanic, right? A big oil tanker. It's 6 months behind easy looking at stuff. So, and trying to predict the future. So I think at this meeting, it'll be a quarter. More importantly, will be what's their kind of horizon on further cuts, right? Hopefully they'll do one more before the end of the year. I think they meet again in November-ish, I think.
Do you think?
I feel like they will with the election. There's just a lot of turmoil in the economy. And
I mean, even though they say the Fed's apolitical, there is political pressure 100%, for sure.
100%. Yeah.
So I agree.
What do you think about unemployment? Do you have a feeling, or do you think the unemployment number is going to go up?
I think it'll go up. It's always, it's a lag time.
Yeah.
Because when you talk to people, they're hurting. I mean, a lot of people, not a lot, but a good portion of people, because I'm getting calls during inflation, they were living on credit card debt. So I'm refinancing people now. And this is true.
Yeah, this is what I call Main Street. You have a pretty good read on Main Street.
This is true. So people have been living off credit card debt. And so they're coming to me with $50,000, $80,000, $120,000. I think the one I just did was $180,000 in credit card debt from paying from anywhere from 20 to 24%. Okay. And they just let the snowball go and trying to it's going to turn.
And they don't have a job.
No, they have a job. It's just because, rent got more expensive or they have a first. I'm sorry, not rent.
Yeah.
They have a first where they don't want to touch it because it's a cover rate, 2.5%, 3%. But look, gas, food, insurance, everything's more expensive. And, a lot of people, 2 incomes to live to make their mortgage payment, right? Even if they got a 2.5%, 3%, right? You still have car payments and other stuff that people get into. Like, if it's their toys, East County, we got our boats and our quads and our
all the things.
Can-Ams and Polaris's now.
Yeah.
So all those things, right? And they don't change their spending, right?
Yeah.
Okay. And so, and they wait, thinking it's going to get better, and it hasn't. So So when they're calling me and they say, hey, I don't want to get rid of my COVID rate, sometimes it's like you don't have an option because a lot of people have a lot of equity.
Yeah.
Because the appreciation of the market.
So that's how I'm trying to figure out why they take the snowball ride.
Right.
Why do they just keep escalating debt? Because they have equity in the back of their mind.
People have these weird beliefs or, limiting beliefs, if you will say, about interest rates. Like everyone wants the low interest rates. And now we've seen, 2-3%, which is absurdly low. We may never see those rates ever again.
Right.
A 6% rate is a good rate, So it's like if you've got a bunch of pent up equity in your home and you've got $150,000 worth of credit card debt at 24%, a 6% cash out or refi to then pay that debt off is way better.
Exactly
so
right. And we can get out of it. It's coaching people and saying, hey, and if the rates come down even more in a year,
we'll refi again.
We'll just go again like you've done before. So let's do it now because you're hemorrhaging right now and your score is getting so low where I'm not going to be able to help you.
Yeah.
Because now your score is below 700. Now you're paying a higher rate to do the cash out because you waited too long. Right. Or there's other people that only have 20 or 30,000. And then maybe we just do a second. We do a HELOC. Right. But more people are doing fixed HELOCs.
Yeah.
Which are around 9%. Okay. But if you do a HELOC, it's more like a credit card on your house because it's open.
Yeah.
And those are 10% or higher. And, people got burned because they did have HELOCs and they saw when the Fed raised 11 times, it was progressively going up. Right.
Yep.
Now
the HELOC's not perfect.
Yeah.
They're not perfect.
It's a little tricky. It's more of like if you wanted to like go flip a home or do something where you had a lot of it, you could use it as a source. But
emergency, some type of home renovation, then you're going to pay back or whatever. But yeah, for some people we're doing seconds because it makes more sense to do that than not touch their COVID rate. So I'm doing more of that, right? Because it makes sense. It's a math problem. It's a puzzle. So every client's different. I look at what their first is, what they're paying, what their credit card debts are, what the rates are. We do a whole thing like, okay, here's your savings. Makes more sense to do a second, not a first. So we do that. And I'm having more and more conversations because people have equity and they want to get out of debt. Right. So I'm doing a lot of debt consolidation, but I'm still doing a lot of renovations. A lot of people ADUs and junior ADUs converting garages because they want that extra income.
What's the best way to finance an ADU?
Good question. They're doing them through HELOCs or HELOANs. Okay. Some with their own cash. There are some products that I'm not privy to through the state, that you can, but I've only had like one person get it and it worked for them because it fit all the, checked all the boxes. But a lot of times it's cash or your equity, there's no other
second or
getting a second or HELOC. So it depends. That's what most people
today earlier, I heard of a guy that does a bunch of ADUs in Solana Beach.
Oh, wow. Okay.
And I'm like, well, that's kind of interesting. So I took his name down, but the guy that was here does HVAC for him on all of his new ADUs. I'm like, man, I like the ADU thing. It's just kind of an interesting
And then sometimes because they do specialize in ADUs, there's like banks that will specialize that.
Yep.
Okay. Which I don't do because it's not tied to your mortgage.
Specialty deal.
Right. It's a specialty thing, which because solar was like that too.
Yep.
Right.
Yep.
There was a lot of people got solar. We don't do solar loans, right? It's through credit unions, right? And other banks, and then a lot of times when they sell or refi, I'm paying them off. Okay. And then there was a hero loan, which was a debacle, but where you could put in your property taxes and that company went bankrupt and it was kind of a scamish. It was really expensive. And people's property taxes got jacked up. The sell was, hey, you can write it off and just incorporate in your property taxes, and then your taxes went way up for years, and then it really wasn't, yes, you got the energy savings from your utility bill, but you definitely didn't get the savings back.
Paid for it. Yeah.
It was a good idea, like communism is on paper, but in reality, it's not. Right. Okay.
So do you think it's going to just keep going on for the next 10 plus years?
I think the Fed's going to slow play rate cuts. I think it'd be really weird if they get really aggressive. That means then they kind of screwed up.
Right.
You know what I mean?
Then the jobs went way up.
Right. I think during COVID, I think in retrospect, they waited too long to start bumping rates up. They kept them low for too long, overheated everything.
Yeah.
Personally. And then with supply chain, COVID stuff, I think they missed it a little bit on that. And then they went, oh, crap. And they raised 11 times historically, which hasn't been, right?
Yep.
And I've been doing mortgages for 32 years. I never did them at 2 and 3% in my 32-year career. Yeah. It's definitely historic, and so was COVID.
Yeah.
Okay. But I think they did it too long, and that's why they went, oh, crap, we got to get aggressive, and they did 11 times. So I think this time, hopefully, they'll be a little bit smarter and learn from that. But I think it'll be slow played.
Yeah.
So, and then I think 2025 will be a good year for me. It should be better, not only for refinances, but maybe for some people that have been waiting and tapping out
and wanting to buy.
Yeah. And I think, so that's why I think prices will stay up, but hopefully it'll bring more inventory because then people, because when they want to sell and I'm showing them at 7-8% payments, they're like, no way, I'm staying at my 2.5. This is stupidity. I can't, I'm not doing it.
Everybody.
So it created a, a low inventory problem.
Yeah. It did.
So I think it'll be good. I'm hoping, with the presidency too, and their fiscal policy, that'll be better.
Yeah.
As well. So I'm hoping I'm really with optimism looking at 25 as a good year in real estate. Yeah. I still think it will be good because money will hopefully be cheaper, get more people to maybe list homes. And I hopefully we will be busier for real estate as a whole for our industry. Right.
Yeah.
So, because people need money. Most people don't have cash to buy a house. Some do. Right. Most people need to, finance
play
it.
The game.
Or it makes sense, right? You don't want to liquidate stuff because you got to pay taxes and stuff. So, but so hopefully it'll be a good year for 25 because for the last 3 years, it's definitely been lots lower for me. So, which is okay.
There's highs and lows.
There's highs and lows in our business. It's never cranking the whole time.
Right.
So I've learned that being 55 is, being a squirrel and putting nuts away for the winter. I knew it's not sustainable. Just like it was in 08, it's not sustainable. And so, but hopefully we get to more of a healthy economy, healthy, slow growth, inflation and unemployment and healthy, parameters. I think it'll be good. And then ARMs are not in vogue, adjustable rate mortgages. So I haven't done an ARM in almost 2 years because it doesn't make sense. Because right now the banks are adverse to risk. And so it was an inverted bond yield. That means where usually short-term rates are lower than long. Where it's not, it's the opposite.
Yep.
Okay. And so when rates start to come up, maybe, or even come down, you'll see the spread change where adjustables might come in vogue again for some people. But a lot of people got, in trouble on the adjustables. And so a lot of people are adverse to that. So, but I have some people say, hey, I'm only going to be in this for 5 years. I'm going to retire and I'm going to sell and I'm going to move somewhere else. Or I'm going to do this or that short-term thing. I want to get a lower payment. I'm going to get a, raise in or promotion, or wife's going to go back to work. So for 3 years, I want it low and then I'm going to refinance. And if I have to pay a higher rate, then great. But right now, this is going to help me. But right now they're not in vogue because it doesn't make sense, but they could come back in vogue. We'll see. So.
Well, cool. Well, thank you. Thank you for the time.
Yeah.
We really enjoyed the chat.
This was fun.
Yeah. Thanks for coming today, Paige. Lots of good content here and it's an adventure.
It is.
Yeah. It's a fun one.